Welcome to Trends with Benefits, a podcast by VanEck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. I am your host, Ed Lopez, and my guest today is Carlos Diez, CEO and founder of MarketGrader.com. MarketGrader provides institutional level research on equities and indices based on company fundamentals for institutions and professional investors. Carlos, thanks for joining me today.
Thanks for having me.
Did I explain MarketGrader correctly?
You did. Very good, actually.
Well, we've been working together for a little while now, and we recently worked together on a couple different products, a China product and an India product. And my intent is not necessarily to talk about those specifically today, but we have several year history of working together, and I'm happy that we could actually do this because every time I talk to you, I'm impressed. You're very well spoken. You know your stuff inside and out. And I'm happy to talk to you about what the main topic of today is, which is China, because you have a particular interest in that market. But, one of the things I like to do in kind of looking at your background is talking about your origin story, if you will. You went to school where, Pepperdine?
I went to Pepperdine in LA. I was young when I started MarketGrader, which had, at least in hindsight, has a lot of advantages and disadvantages. The disadvantages have to do with all the stuff that I didn't know, which is pretty much nothing compared to all the mistakes that have taught me a lot of lessons in the last 20, 21 years. But the flip side of that is that's also what makes you want to start something when you're young, that you don't know a lot of what lies ahead. You don't know about the roadblocks. You don't know about the obstacles. So you just want to build something. You want to do something great. And so you don't think about negative consequences. So I was 23 when I started MarketGrader. I was actually thinking about MarketGrader while I was still at Pepperdine. So I went to school through the late 90s, basically, in California. So I saw a lot of the dot-com boom live through friends of mine in school, actually. I remember vividly soccer practice. I was on the soccer team, and before soccer practice, stocks were the kind of like the theme du jour. And so buddies of mine came in talking about how they had bought this stock and that stock. And I would ask them what they did. And most of the time they didn't know what the company did. And I asked them if the company was making money. They didn't know that either. And we're students, so it's not like we have a lot of money to invest. So they're putting, $500, $1,000, $2,000 here or there. And I felt that it would not end up well because, they were just really speculating. So that was kind of the idea behind MarketGrader.
Were you taking classes at the time that helped inform your thoughts on that? I mean, I kind of also find it kind of interesting that MarketGrader is very fundamentally based, growth, value, those type of different factors, which I guess I didn't learn about until I was into my career and got exposure to a lot of different areas.
Right. So I was an economics major, but I always gravitated towards finance. So I always took all the finance-related classes that I could. Once I was done with my econ curriculum, I focused on finance-related classes, some accounting classes that I found interesting, not because I liked accounting as a prospective career, but because it was a way to understand how companies make money, how their business ran. And I also had a particular interest in history. So I always thought that and I was always fascinated by the role that capital markets play in a developing economy, or any economy for that matter, and how, if a country gets that wrong or right, it makes all the difference for its economic development. So I just thought about the companies that they were buying. I had an interest in the stock market, but knew very little about it. I just didn't think it would end up well. And not that I knew why at the time, but the fact that everyone was doing it, when everyone is doing something, it often tends to...
It's got to be wrong.
Right. So it was partly instinctive and luck, I guess, that I just kind of thought that way. And I've always had sort of a very rational sort of mind, which at times serves me well, at times it does not. And so I always try to find the explanation behind something. If somebody told me this stock is up 50% the last 3 months, I wonder, does that mean that their business grew 50% the last 3 months? Or if not, then what's the underlying reasoning for it?
And then so your idea around MarketGrader at the time was to try to find a business that helped explain why companies were moving.
Yeah. So I started thinking about, what could investors do differently than they were doing at the time, which was really speculating. And there was also the rise of all the day trading platforms and all that. So ironically, I also thought that the rise of the internet was also the perfect opportunity to use as a medium to disseminate information that was already public. A company already tells you what they're doing, how they're doing, and they do so on a quarterly basis. So why not take that and use the internet as a way to disseminate that information? But I felt it was important to not just disseminate the information. I said, you need to actually analyze that and make some sense of it from a purely numbers perspective, from a quantitative perspective. And so that was the real genesis behind MarketGrader. I said, is there a way to kind of download all this data in bulk, analyze it, and at least put out a rating that allowed people to better know these companies, so that at least they were jumping in with maybe not both eyes closed, but at least one of them open.
And so the platform itself, like the market grading of stocks, that was established 2003, where people can sign up with a subscription and go get a rating based on your methodology on particular stocks, global stocks, U.S. stocks, which I think is really cool. You went into indices. You were also an early participant in ETFs. What did you learn with your involvement with ETFs early in 2007?
A lot. When we started in the business, I just went out to see who we could partner with. A small company, unknown at the time in the indexing space. There were really just a handful of like big companies. None of the newer index companies were really doing indexes yet. So I started really knocking on doors, and I had developed a relationship with a company called London and Capital. They were not a product company. They were kind of like a wealth management office, a family office kind of in London. I developed a very good relationship with its owners and managers, and they licensed the first index, and they created a structured product in Ireland and a fund in London. They did very well. And so they heard me talk about ETFs all the time, and eventually they said, hey, why don't we do the ETFs together? We'll create a company to do all this. And back then, if you recall, starting an ETF took a lot of time and a lot of money. Getting an exemption relief could be $1 million proposition, and 12 to 18 month kind of wait. So they went through all that process, and they put together a platform of what eventually became 18 MarketGrader ETFs in the US and in Europe, London and Italy. So the one thing I learned the most is that you better get distribution right if you're going to do this, especially in the United States. And I don't think they understood that. I kind of alluded to the fact that financial advisors were key to help an ETF get off the ground. And the financial advisor model that we have in the US doesn't really exist in Europe the same way. So I think they kind of figured that they could somehow make up for it in other ways. And so they just didn't have that distribution, and they launched in late 2007, early 2008, all these funds. So obviously timing was poor. The funds did well relative to all their peers in the early going, but then obviously 2008 happened, and so they rode the market all the way down, and they decided to shut down the company, the whole ETF company called SPY ETFs at the time, in March of 2009. So lesson number one, distribution. And if you are giving investors a long-term exposure, which is what we are focused on, you better have a plan and the staying power to see it through. And you better have the fortitude to see it through market cycles. The market's going to do what the market does. It's going to go up and down, but in the end, if your methodology is sound, and ours is, I think, you will be fine. So, and then lesson number two, luck. Luck is probably the biggest component in business that people don't like to talk about, because obviously everyone likes to highlight their skills, but we were just a little bit unlucky. So I learned that.
Well, luck is a little bit of a intangible. You almost got to make your own luck. Just start doing something, right? And
Sure.
hopefully things will pan out. But you're so right about distribution. I think it's even gotten tougher for issuers, and particularly small issuers, with the distribution game. I mean, back when I got involved with ETFs, probably 2004, 2005 or so, you could pretty much launch anything and it could be successful.
Right.
But yeah, definitely distribution is a major factor, and then timing of the market too. Just whatever the environment is also another major factor. You talked a little bit about your methodology. I guess your basic philosophy is a GARP style approach, right? Did you start out with that, or did you over time kind of land on a kind of GARP-y approach?
I think we did. Maybe we didn't call it GARP from day one, but one of the things that we thought we wanted to accomplish with our methodology was to give an investors a solution that could actually look at both growth and value and incorporate the best elements of both into a strategy. That's basically GARP. So we always felt, I still do, that investors are given a false choice between growth or value. Are you either a growth investor or a value investor? I think you can be both. So first and foremost, I think growth matters most, because the natural tendency of humans, the natural tendency of the stock market is to grow, is to move in an upward direction. For an investment strategy, you have to focus on how you can harness that growth, whether it be for a specific country, a sector, what have you. So growth is the most important. And in this case, we're looking at how companies grow. Value is important in the sense that you want to make sure that you don't overpay for that growth. But that doesn't mean we're not dogmatic about value, meaning if a company is above or below a certain PE, we don't consider it expensive or inexpensive. I think it all comes back to the quality of the company. And that's kind of the third component, if you will, which is the quality aspect, which is very important. So our analysis is based on really 4 areas of fundamentals: growth, value, like I just described, and then profitability and cash flow, that are always important. You want to own a company that is doing well no matter what they do, that has sustainable margins. We think capital allocation is very important. Capital allocation, or wise capital allocation decisions, actually over time come through consistently for shareholders. Cash flow is important. So it was always that kind of balance between growth and value and the quality aspect. And that's what we've done since the beginning. And that's what we do today globally. So when we started it was purely a North American oriented platform, meaning we covered only US and Canadian stocks. Today we cover, as you know, companies globally. We cover about 38,000 companies globally. So, and it works as well elsewhere. In fact, it works better in other places where markets are less efficient, where there's more opportunity to identify, to do security selection.
And so let's talk about some of the international markets. And you kind of alluded to the ability to use this methodology perhaps to a greater effect in some markets that are less efficient. How about China? If you go to your website, you'll see, or people will find a number of different research reports on China. Do you have a personal interest in China, and what has driven that over time?
I would say it's partly personal interest. I have a personal interest in China and Chinese culture overall. Very big part of it is also an interest in the investment opportunity in China. And a lot has been said and written. We have written some of it about what China has done so far, which has been incredible. But I think what excites me the most is what China is planning to do or trying to do in the future, to go from where they are today, to translate what they have achieved into true prosperity for Chinese citizens. China's per capita GDP is still about a sixth of between a fifth and a sixth of US per capita GDP. So rather than focus on, are they going to be bigger than the US by 2028 or what have you, I think what's important is to think about what that ongoing growth will translate into for the average Chinese citizen. And is that going to benefit investors that own public companies in China? We believe that it is. So those are kind of the long-term kind of macro themes that I really like about China that I think are not available anywhere else in the world. Really.
So a lot has been said, over the last couple of years about China's weight in broad-based emerging market indices. I think, I don't know, the MSCI EM, where's China? About 40% of that index, something like that. Do you think that that's well represented? Do you think that's adequately represented, or is that too much to have in a broad-based index?
It depends on what that 40 or 50% represents. If it's if it's 40% of a lot of the stuff you're getting in the benchmarks today, it's maybe 30% too much. If it's 40% of the parts of China that we like the most, maybe it could be maybe 10% too little. So if you look purely at market cap and just look at the you arrange all markets globally based on market cap, that's getting close to China's global footprint in terms of market size. However, if you do it purely based on market cap, you're going to own a lot of companies that you really don't want to own. A lot of the larger companies in China are state-owned enterprises, and you don't necessarily want to own that. So going back to MSCI, I think the MSCI China Index has something like 50% of its market cap weight in state-owned enterprises. So essentially, and those companies have something like only a third of their shares freely tradable in China. So you're really a passenger riding in a car driven by the Chinese state. And I don't think that's where you want to be. And again, that's not a political statement. It's more an economic statement based on unexpected returns. When you have in China or anywhere, you have a state-owned enterprise, they have sort of a dual mandate, right? One is the usual mandate to maximize return for shareholders, but that plays second fiddle to their primary mandate, which is to do what the state requires them to do. So the state says, we need you to help us build this infrastructure in this other country. We need you to allocate credit to this set of projects. That's not necessarily aligned with shareholders' interest, meaning those are likely lower returning endeavors that don't bode well for the public shareholders. So you want to avoid that as much as possible and focus on the companies that are, where the growth really is. So
yeah, and I guess there is a little bit of a political element to it today too, right? I mean, just in headlines this year of our approach and our relationship with China and investing in China. I think it was Rubio that was putting through a proposal or trying to put through a proposal about having federal pension funds not invest in companies that basically state-owned companies, I think, or that supported the military complex or basically supported your enemy. Should investors be concerned about that?
It's not an unreasonable concern to have, but my question would be, who becomes the arbiter of that? Who determines what is a company that is helping the state versus not? Flip. And again, I'm not an apologist for China, but flip the script and say, is Microsoft a company that is enabling the U.S. military? It might be, it might not be. They have a huge cloud computing contract with, I think, the State Department now. So does that make them a bad company to own? I don't think that's what I would be looking at if I were deciding to invest in Microsoft or not. There are clearly companies that are purely state-owned enterprises controlled by the state in China that are very easy to identify. And yes, I think it makes sense to say, it's better maybe not to own those companies. But there are a lot of companies where, do they provide or not services or wares to the state and the military? That's a bit more of a gray area. So we try to stay away from that, and we focus, like I said before, on the company fundamentals. You're more likely than not to end up with a portfolio that has companies with a very small state footprint, simply because, again, they're going to have high returns, high growth rates. They're just better companies. So it's kind of a circuitous way to arrive at that non-SOE exposure to China.
Does the current U.S.-China trade war give you pause at all as a U.S. investor considering an allocation to China? Is that something that investors should wait and see what plays out?
I wouldn't. I wouldn't wait for some kind of resolution. There might not be a clear-cut resolution to the trade war. So I would not wait to allocate to China. If I haven't done so as an investor, I would not wait until there's some kind of resolution, because, like I mentioned before, China's growth is too big a part of global growth for you not to participate. Having said that, there are a few things about the trade war that give me pause, but I look at it mostly from an optimist point of view. So I think there's some silver linings in what's happening. I think number one, they might not say so explicitly, but the Chinese recognize the need for domestic reform. And that includes, financial services reform. They're engaged in that. Pension reform. They also recognize, again, they might not be too explicit about it, that they need to treat foreign companies and foreign investors better when they come to China. So to the extent that they accelerate and continue with these reforms, I think this might be a silver lining. That might be a bit naive of me, but I think over time, I don't think the Chinese would want to disengage fully from the world. So in fits and starts, there might be some of that reform. So this might be a catalyst for that positive change. And then to the extent that they continue to focus on their domestic economic development, which is focused on, consumers and the service part of the economy and their homegrown technology, that is only going to favor some of the sectors that we like, that our methodology identifies as the best, fastest growing sectors, healthcare, consumer staples, consumers, discretionary services, technology, and so forth. So, but then the part that gives me pause is I think you have to be mindful of how you have to give China a gracious way out, because the image of the Chinese party, and again, this is not a political statement, is for them, it's the most important thing domestically. So you have to give them an opportunity to say, you know what, there are things that we need to change, and we can turn around and modify those without looking weak to the Chinese people. So if you give them that opportunity, hopefully we can find a middle ground where they can re-engage and continue to grow. So what gives me pause is maybe putting them too far into a corner where they just completely go inward and say, you know what, we're going to disengage and this doesn't make sense and we're just going to do it the Chinese way. And that's just not going to benefit anyone.
When was the last time you were in China?
I'm afraid to disclose that because I don't want to be blamed for the virus coming to the U.S. I was in China. I came back from China, I think December 1st of last year.
Sometime last year, okay.
Sometime last year, yeah.
And this is kind of a broad question, but did anything stand out to you that just, reiterated your view, your investment view on China?
Yeah, I mean, it's dynamic, the dynamism and I'm not talking about the huge companies, and I'm not talking about meetings with like executives and things like that. I'm talking about the stuff you see with people that you talk to on a regular basis. Over the years, you develop friendships in China, and Chinese business people, entrepreneurs are no different than they are from us here. They're very entrepreneurial. They're very creative. They're looking for opportunities. They're looking to build their business. It happens to be that they have a big brother looking over their shoulder, so that kind of makes everything different. But there's a lot of dynamism. There's a lot of positive things going on.
Have you been following the development of the STAR market and Chinext and their efforts towards smaller technology companies and more listings, I guess?
Yes. Obviously, Ant Financial being Ant Group now, being kind of the star of the new STAR market, coming to market soon. I was a little surprised that they kind of redid this because they've already done this before. The Shenzhen, and especially Shenzhen's Chinext, was supposed to be that kind of NASDAQ-like board. So if you look at the two exchanges right now, up until now, the better companies, more dynamic companies in tech, internet services, biotechnology have listed in Shenzhen. Shanghai has been most of the market where the large state-owned enterprises, the large banks, some of the big companies, the old smokestack kind of industries have listed. So it's pretty interesting to see that they're now focused on building up this market. I think the fact that Ant Group's going to go public there is going to give them a huge boost. I think that company is tremendous. We saw some of the numbers. I'm actually working my way through the prospectus right now, trying to. I think it's fascinating. So I think it's going to be the fact that they're getting Ant Group to list there. I think that's going to make a big difference to them.
Yeah. Do you think some of that is good news from the fact of, I guess there's this push to delist some China companies here in the U.S. I mean, is that a big deal at all? I mean, there seems like there might be a a nice welcoming market in China for them to list if they want to.
So I think that I don't think that the US is necessarily trying to get the Chinese companies to delist from the US. Some people certainly present it that way. I think that's a mistake. I think that's a mistake because, number one, we have the deepest, most important capital markets in the world. We start shutting it down to parts of the world. That doesn't bode well for us. It doesn't bode well for US investors that might want to own some of that growth that I described before. But I think if it's framed differently, meaning, hey, we're not saying leave the US because you're not welcome anymore, but you need to play by the same rules that all other companies do, meaning you need to give us access to your financials like everybody else does and allow us to audit them just like everybody else does. I think that's fair. And some companies like Alibaba have done that from the outset. And I think, again, these are global companies that want to be, world-class companies. You can't be a world-class company if you say, well, we're going to do accounting our way and then let everybody else follow, global guidelines. So we'll see how it plays out. Fortunately for us, and I say us, I mean, MarketGrader, but also broadly US and foreign investors, China's market is now open enough that you can access those opportunities even if they're not here. As you know, we can invest directly in Chinese companies listed in Shanghai and Shenzhen, either directly through quotas, which they're actually doing away with, or also through the Stock Connect program, which has grown tremendously in the number of companies. So again, it's a global capital market, and whether the company is listed in Shanghai or Hong Kong or New York, if it's a good company, you want to own it.
As part of the podcast, we look at trends, and I'm also interested in what you are considering in terms of the future. What's one long-term trend you see playing out over the next year or several years?
From an investment perspective, and keep in mind that I usually come at this from the equity perspective always. There's two global sectors that I think have massive tailwinds behind them that are going to continue to be growth sectors for a long time. One of them is healthcare, because on the one hand, there's a massive need for more investment in healthcare infrastructure in emerging economies for them to catch up to developed economies. So I think that's going to drive a lot of investment in all kinds of healthcare related industry. Plus, we're always, as a society, always going to require healthcare, right? It's never going to go away. So that's one trend that I think is important in the long run. Technology is the other, although that might seem like a crowded space right now. Thinking long term, technology, I don't think only in terms of the companies that are today's technology leaders, but I think about what technology is doing to enable other industries. So to the extent that you're able to harness what technology is doing globally in the long run, those are the two kind of sectors that I like the most. And then from a country/regional perspective, I think outside of China and India being two big emerging markets, outside of those, I really like Southeast Asia going forward for a number of reasons. They have mostly pretty favorable demographics. They have made very good strides in how their economic policy, by and large, has been conducted the last few years. I think some of these economies learned a lot from the currency crisis they had in the late 90s and have done things better. I think they're going to benefit from some of what's happening between the rest of the world and China. Obviously, you've seen some of the migration of certain supply chains and some industries to Vietnam. But I think, there's large populations in Indonesia, Malaysia. They have a very sound capital market from which they can incentivize all that or capitalize that, which is Singapore. So I think that region, is maybe going to act sort of as a counterbalance to China in Asia. So it behooves investors to look at it as and it behooves the U.S. to engage with Southeast Asian economies for our benefit and global benefits. So those are kind of the broad trends that I see that I like.
So let's do our speed round. It's trend or fad. I'll mention a few different concepts. You let me know quickly whether it's trend or fad. You can explain it if you like.
Okay.
Moving production away from China to other countries. Trend or fad?
Trend.
Connected home fitness. Trend or fad?
Such as like Peloton bike, for example.
Like Peloton bike or those mirrors you can work out in front of.
Haven't seen those. I would say if I had to pick between the two, I would say mostly fad.
ESG, trend or fad?
Both. So quick explanation. I think trend in the sense that investors will continue to think about their investments and their allocations in ways that go beyond just the traditional factors they looked at when they allocate capital, meaning they're going to look for companies that are doing good, that are not damaging the environment. So I think that's a trend. I think it's a fad in the sense that, there's too many Me Too products out there. I think people need to realize that ESG is not an easy quantifiable metric or set of metrics. It's very subjective. So it's not something that's going to happen overnight. It's going to take time for it to develop into a more cohesive set of tools that we look at. So that's definitely not a quick round sort of answer.
No, but it's perfect. And you've helped me prepare for another podcast I'm going to have on ESG specifically. And I've asked that question of a number of podcast guests, partly because I agree with you to some extent. There is a trend towards that mindset and awareness of the environment and better governance in companies, but also perhaps the way that the industry has approached it is kind of faddish, where it's almost like check the box, if you will, ESG and a bunch of different methodologies.
Yeah, and I think some of it is really silly. I think when you jump to judgment and say, "Oh, this company is bad because they only have so many minorities in their board of directors," I think that's kind of superficial. Or their employee distribution is broken down this way. I think it takes some critical analysis to really understand why that's the case. Or the environment. How are you going to measure the environmental impact of a community bank down the street relative to an industry that is completely unrelated? So, it takes a lot more qualitative than quantitative approach at this stage.
We'll leave it there. What's the best way for people to follow MarketGrader and follow you?
Well, MarketGrader.com, the best way. Hopefully people subscribe to our research. That's definitely the best way. I could be reached at Diez, my last name, DIEZ, at MarketGrader.com. But two best ways to stay in touch with me.
Fantastic. Carlos, thanks again for joining me.
Thank you. Thanks for having me, Ed.
And thanks for tuning in to another episode of Trends with Benefits.